Warren Buffett's annual letter, it's so much more than just a report. It's really a masterclass in capital allocation. So in this explainer, we're going to distill the core philosophies from his latest communication and really focus on the practical lessons that we, as professional investors, can actually use.
All right, let's just dive right in. And you'll notice we're not starting with some triumphant, headline-grabbing number. We're starting with a philosophy. And this is absolutely key to understanding Berkshire's long-term edge. It's this idea that just a few great decisions can make a truly breathtaking difference over time, more than enough to cover for all the inevitable mistakes you're going to make along the way.
And right away, this slide just nails the first key difference. Buffett makes the point of calling his letter a true report, what he'd want to know if he was in our shoes. And you can see it's a total rejection of those glossy, happy talk documents that are so common. For any analyst, this difference in communication, well, it's a powerful first screen for the quality of management you're dealing with.
So here's the crucial point. This honesty, this candor, it isn't just some folksy quirk of Buffett's. It is a genuine strategic advantage. It creates a culture where problems get tackled head-on, not swept under the rug.
And check this out. We can actually quantify it. Buffett himself points out in the letter that he's used the words mistake or error 16 times in just the last 5 years. And then he notes that many other giant corporations, well, they never use either word. As an analyst, that's a hard data point. It's a signal of a culture that's avoiding that incredibly dangerous trap of pretending management is perfect.
And here we have it, a key insight from Charlie Munger that Buffett made sure to include. The problem isn't making mistakes. That's just a given, in business and in investing. The real failure, the cardinal sin as Munger called it, is what he called thumb-sucking, that inability to act decisively once you know you've messed up.
Okay, so this whole philosophy of acting decisively, it leads directly into the next core principle. You've got to find the right people. And the story of Pete Liegl, the founder of the RV maker Forest River, is just the perfect case study in how Buffett thinks about talent. I mean, just look at this timeline. A multi-billion-dollar deal, done, in 1 week, with one meeting. It's the complete opposite of a typical M&A process that gets bogged down with armies of bankers and lawyers. The diligence was simple, right? Buffett called a few dealers, then he met the guy. The whole thing was a bet on character, plain and simple.
And this is the payoff. When Buffett asked him to name his salary, this is what Liegl said. It's an almost unbelievable story, but it tells you absolutely everything you need to know about his character and the immediate alignment of interests. This is the kind of owner-manager who can create billions and billions in value.
So what's the framework we can take away from this? Well, Buffett fundamentally believes that a huge chunk of business talent is just innate. He famously never looks at where someone went to school. Instead, he's hunting for these naturals, people who have an instinctive genius for business no matter what their formal resume says. For us, when we're evaluating management teams, it's a huge reminder to look beyond the Ivy League degree.
All right, let's shift gears and unpack Berkshire's core capital allocation strategy. Buffett describes it as being kind of ambidextrous, using two different ways to own pieces of businesses.
So on one hand, you've got the wholly owned businesses. Here, Berkshire has total control over capital decisions, which is great, but mistakes are really hard to undo. Then, on the other hand, you have marketable stocks. You have zero control, but you get liquidity, and you get the chance to buy pieces of incredible businesses at bargain prices when Wall Street is panicking. The key is, Berkshire is totally impartial. It puts the capital wherever the opportunity is best.
And this right here is the guiding principle behind all of it. It's such a powerful statement against trying to time the market. Even though Berkshire holds a ton of cash, the default setting is always to be invested in productive assets. The long-term preference is crystal clear. Own businesses, not cash.
Okay, now let's get into the financial engine room of this whole operation. Because really, to understand Berkshire, you absolutely have to understand the power of its insurance business and this concept of float. The scale of this engine is just staggering. The float, that's the money from premiums that Berkshire collects up front and gets to invest before paying out claims, it's nearly quadrupled in the last 2 decades. It went from $46 billion to $171 billion. That's not just growth. That is the expansion of a massive strategic capital base. So the really crucial point for us as investors is this: float is not a normal liability.
It is a massive pool of other people's money that Berkshire gets to invest for its own benefit. And because their underwriting is so disciplined, this capital has, on average, been better than free. It's an incredible advantage. This quote just perfectly captures the mindset you need to make it all work. See, pricing insurance properly, it's not a business for optimists. It requires this culture of disciplined risk-taking, where you're constantly aware of the downside, but you're not afraid to write policies when the price is right. It's that art and science that really fuels the whole Berkshire enterprise.
So let's zoom out to the macro view for a second and see how this entire philosophy gets expressed in a few very large, very long-term bets.
Now, even though Berkshire is overwhelmingly focused on the U.S., its growing position in these 5 major Japanese trading houses is a really fascinating case study. Why? Because Buffett saw businesses that fit the model. They had durable advantages, they were trading at low prices, and they were run by managers he could trust. It's a decades-long bet. And notice, it's structured to be currency neutral. It just shows that his core principles can be applied anywhere.
But despite that big investment in Japan, Buffett always brings it all back home. This statement is the absolute bedrock of his philosophy. He's completely unequivocal that Berkshire is a product of the American economic miracle, a system that, in his words, has unleashed human potential like no other.
And here it is. This is the ultimate proof of that conviction. The numbers just speak for themselves, don't they? Since 1965, Berkshire's compounded annual gain has been nearly 20%, almost double the S&P 500's return over that same very long period. It is the definitive proof of the power of this entire philosophy. And so that leaves us with the central question for every single one of us investing today. In a market that seems totally obsessed with speed, short-term pressure, and algorithms, can these foundational principles, candor, focusing on character, and just unwavering long-term conviction, can they still be applied to generate these kinds of results? That's really the challenge and the opportunity in Buffett's 2024 letter.